Our last portion of the FX Master, we're going to dive into Fibonacci extensions. So we talked about the history of Fibonacci's, what the sequence is and why it shows up in nature, and we as human beings are just animals. Basically we're emotional. We make decisions that are emotional. So studying human nature makes a lot of sense from a financial perspective. Then we talked about retracements. If you're going to buy the dip or sell on rallies, you want to do it only when there's a strong trending environment and the key levels to look for. Now, Fibonacci Extensions speaks to price targets. Once you get into a trade, where's it likely to go? Well, we don't use a lot of extensions, but we will use one specifically. Extension levels are given automatically on many of the charting platforms that you'll look at, for example, on interactive brokers. The key ratios, depending on how you draw them, these two numbers are exact opposites essentially. So you'll either have a negative 61.8, or I think that actually should be a positive 161.8. Meaning I always draw these ratios, I always draw the Fibonacci lines so that mine show up as a negative 61.8% target. And that'll make sense in a minute. But if you were to drag the lines the opposite way, the reason you wouldn't want to do that is it would flip around your retracements. It would show you that you retrace 61.8 first before you retrace back 38.2, which really doesn't make sense. But if you did, then it would flip it to a 161.8 target. I'll make sense of this in a second. Don't get too worried. So remember, they're still horizontal lines. It's simply just a price level that you can identify as a possible target. If this asset makes new highs, that's your bullish Fibonacci target, or if the asset breaks to new lows, if you're trading bearishly, that becomes your downside target. Now, a lot of concern that we get from traders is, well, what happens when something's at new all-time highs or new all-time lows? We don't really have any targets. In other words, if this is the highest level that this currency pair has ever traded at, we don't know what to project up here. Well, these Fibonacci targets will always give you a number. They just basically measure the prior move and then target 61.8% beyond that based on the prior trading range. Again, we kind of need to dig into the numbers so this makes more sense, but I'm just trying to build a foundation that we can work off of. Here's what it looks like. This was a prior example that we showed in the retracement section, where the currency pair had made a pivot low down here. You see the swing low, which was at a number of 132.96. It had made a swing high, which was up here at a number of 134.37. That is the trading range. Then you had your retracements. Here's the 38.2% retracement, which is where it found support. Down here would have been a 61.8. But the question is, how high can this thing go? What the Fibonacci targets will do, extensions will do, is give you that, as it calls it, a negative 61.8% target, which is literally a move 61.8% of this trading range. Meaning whatever the size of this trading range is, it will give you a target that is 61.8% above that. Okay? That same size. So some people look at that and they say, well, is it telling me that this asset is going to go up 61.8%? No. It's not that big of a move. It's, hey, we moved, $1.50 here. If you break to new highs, these currencies have a very strong likelihood of going 61.8% beyond that, or making, in other words, a 161.8% total move from the lowest point to what would be your upside target. Now this comes back to the golden ratio. Remember, it's always about, with Fibonacci, It always comes back to those golden ratio numbers. And it's literally, I don't want to make it sound like an exact science because I always emphasize it's just not perfect. But it gives you about as good a target as you can ever come up with on your own. It's statistically based. It uses the asset's personality. It's not just throwing some random number. It's saying, well, how much did it move previously? And then if we break out, here's how much it should move in the future based on that stock's or currency's personality. Because it's not just throwing out a number, it's using these numbers that the actual asset has accomplished and then projecting that out, right? Pretty cool stuff. Let me show you a couple of examples. Here's a bearish example. If we're trading on the bear side, you measure the downside move. Well, the downside move was from peak to trough. That's the total move. It will give you a target that is 61.8% of that amount, which happens to be the big rectangle, right? There's a smaller rectangle and a larger rectangle. It's the big rectangle size projected on the downside, okay? Equal distance from 61.8% to 0 is from 0 to negative 61.8. Those are equal distance moves, okay? And traders will often refer to this as a measured move approach. You're measuring out the likelihood of how far we extend. Here was that distance of the larger rectangle. Here is the larger rectangle projected to the downside. Of course, this one's projected down. Why? Because it's a bearish chart. The currency is making new lows. If the currency pair is making new lows, then it's likely to go down 61.8% of the prior trading range in distance on the other side. Gives you a very good probability to manage on your risk to reward. I agree entirely. Now, just to make sure we're on the same page, let's go through it a little bit further. The idea behind extension targets is to use the currency pair's recent moves or volatility to project out an educated guess as to how far it's going to go. Remember, it's either negative 61.8 or positive 161.8, depending on how you drag the lines. I'm going to go live here in just a moment and show you some examples of drawing these, and I hope that's where we kind of tie all these pieces together. These numbers are an upside or downside target using the prior measured trading range. Let's break down a scenario with some math behind it. If you have a currency pair that just moved 100 pips from its swing low to its swing high, first we'd measure that move to get our retracement target, so we know it's 100 pips. Well, what's 61.8% of 100 pips? Well, it's 61.8 pips. So if the prior high was 1.200, then this should move 61.8% of the prior range, which was 100 pips, or 61.8 pips beyond that. So it would give you a target of 61.8 pips above the prior swing highs on a bullish target. It would give you, if this were a bearish example, you'd take 61.8% of the trading range and take that and subtract it from the swing low, and that would give you your downside target. One more example on the same concept with a chart. Here is a chart that shows a trading range. So we have the swing high up here, and we have the swing low down here. That's what we're measuring. The swing high, and it gives you the number, 184.43. So this is a Japanese yen pair. 184.43 is the swing high. It gives you the swing low price, 174.84. There's that number. So what's the size of your trading range? Well, it's the difference between those two numbers, and that is shown right here. Okay? So now we have the math of the trading range, 959. So what's 61.8% of 959? Well, you can mathematically calculate that out. You can say 61.8% of 959, do it on your calculator. Or, of course, the drawing tools will do it for you, but we're showing you the math. 61.8% of 959 is 593. So if 593 is 61.8% of that number, your fib target would be what? Well, prior swing high, 184.43, plus 61.8% of the trading range, which was 593. Add those together, and it will give you your target. Notice, here's the prior swing high. Here is the distance of the 61.8 to this, which happens to be $5.93 or 593 on the pip count for this yen pair. 593 projected upward is the same amount. And guess what that is? 190.36 would be your upside target as far as how far this can go as we break to new highs and make a strong move. Let's go through this with some live examples. I'm going to jump over now to some live examples, and we'll show bullish and bearish and kind of show you how to utilize these. And you don't want to overthink it. You don't want to get too complex. It really shouldn't work that way. So we just want it to be kind of the KISS method. Keep it simple, stupid. So in terms of a chart, I have here Aussie yen, and we'll pull some randomly, but this was one that somebody had requested. Now you can see some bullish examples and you can see some bearish examples. Let's simplify this down to the point where we just think about swing highs and swing lows. So I'm just going to kind of make a marking where some swing highs and swing lows are so that you can kind of see trends and momentum and some of the different things that are happening and where you would drag Fibonacci lines and whatnot. So if we think about this realistically, logically, as we've already taught, where can we drag Fibonacci lines? Well, we can drag them here because this was a big, nice, strong upside move. We could drag them here. This was a move to new highs. We cannot drag this one. It didn't go to new highs or any in between here. We can start dragging them to the downside here because we fell to new lows. We can measure here. We can not measure here because there's no new lows, no new highs. Now we can measure this one and so forth. So as you just drag in your lines, all you do is right click on the chart and click on Add Fibonacci Line. Now I'm going to drag it from peak to trough. And as I do that, it's going to throw in my lines. Now, all I'm doing is spanning from 0 to 100%. So when I do a bullish Fibonacci line and snap it into place, I'm going to start at the peak and drag to the prior swing low. There's the 0%, there's the 100%, and notice from peak to trough, here's the buy zone. As we started to pull back is when we would have started drawing these. There's your 38.2% retracement. You could do worse than buying a currency pair right here at your 38.2 and having it run to new highs. Not too bad, right? Well, the trend kind of stalled out, right? And as it stalled out there, well, no big deal. We can start to trade bearishly, and there would be some bearish examples and things as well. So let me take this off, and now let's go. If I right click, I can remove all trend lines. Let's show a bearish example. Clearly here was a big drop. So I'm going to measure once we started to rally. I can't measure until we start making a pivot low. But once we started to bounce, and this is a daily chart, so once you started to bounce for a couple of days, I'm going to right click on the chart and hit Add Fibonacci Line, but now I'm going to drag them the opposite way. I'm going to drag from the low to the preceding high. There's your high right up here, right? So that's the length of the fall, of the decline, right? It spans from 0 to 100%. So as we retraced, look at where we failed. We basically came up, hit the 38.2, fell all the way back, came up again, actually hit 50%, and then fell back. So it kind of chopped around, but you'd have made some money. I mean, that's a 4 or 5 day decline in your favor. Then it came back to break even, and then it made the huge move. Remember that 61.8 target? In this case, it's a target on the downside because here's the distance of 0 to 61.8. So if you break to new lows, which this did, you should make that equal distanced move on the downside. And that's where it was achieved at 84.76, which just so happens to be exactly where we closed on that particular day. I don't think that that was coincidence. Again, I think it was there's reasons behind that. There was, profit taking that started to take place, because if you were bearish on the currency and you get that big dramatic move in your favor, you're inclined to want to take some money off the table. Gives you very effective, efficient levels to work off of. Let's do a couple more examples. Let me see other currencies that you all requested. And again, we'll just kind of take first come, first serve and try to pull as many of these as possible. All right. So USD Kiwi. Let's take a look. Where do I have that? So Kiwi, US dollar. Whoops. Before we do that, let me clean up this chart. I'm going to right click, remove all trend lines, and then I'll drag over the Kiwi dollar pair. So this one pretty much gives you bearish examples throughout. I'm going to remove all the prior trend lines, and you can use them every step of the way. Here'd be the first one that you'd have measured. Did we fall to new lows? Let me do the same thing I did before. So if I just start marking pivot highs and pivot lows, just so you can see where you could potentially draw them. Basically, we weren't making any new highs, but we were making some higher lows. So this is just a big trading range. Well, it never broke out of it on the upside, but it did break on the downside. So here's why I said this is the first one we can measure, because it actually fell to lower lows. See how this was clearly a lower low than these prior lows. So that's what we're measuring. Okay. I'm going to right click, I'm going to add my Fibonacci line, I'm going to start at the lows, drag up to the prior high so that it snaps right on that. And I usually use the wicks. So from wick to wick, that's 100% of the move. So as we retraced, now you all requested this currency pair. I didn't pull it up for any specific reason. I didn't know whether it'd work or not, but is it pretty cool that it landed right at that 61.8% retracement as it rallied here for a couple of days? That's where you got short the pair. Why were you shorting it? Because it's bearish. It just made new lows. Here's your short entry right around these levels. And what would have been your target? Well, 61.8 would have been a big, hefty target. But it can get there if it can break to new lows, and sure enough, zipped all the way down there and then some. But you see how that works. Pretty cool stuff, where you can literally kind of drag out these lines and figure out the likelihood. And there's only two spots. The retracement levels are basically in that 38.2 to 61.8. We know high and low bases will kind of stay in that 23.6 range. So if this was really weak, it would have just chopped here in the 23.6 and created a low base. If it had a little bit more of a pullback, we're either going to start shorting around 38.2 or 61.8. Those are the two big zones, and away we go to the downside. Pretty cool. Okay, let's do one more. Great question. James asks, would you advise a legging in strategy using Fibonacci retracements to reduce risk? You can absolutely do that. I know that there are institutions that actually do it a little bit opposite. Well, I still think this is okay, but we say average in on profitable trades. This is one of the rare setups where you could average in as it goes against you, but only at two levels. In other words, you could short some at 38.2 And then if it keeps going, short a little more at 61.8. Well, guess what? The reason you do that is in case it stops at 38.2 and then really plummets, you still at least have a half position that's making you some money. But if it gets to the 61.8, your average entry price is at the 50% retracement. So you're down in the trade, but you're not down a lot. You averaged in at 2 great levels. You might stop out, but you'd have an average price of basically the 50% number and an expectation that we could fall all the way down here to the target. If you look at the risk to reward, everything in trading is about managing risk. If I'm entering up here, where am I stopping out? Remember, I said that it's very common to stop out above the 61.8. That'd be a bad sign. So your risk is relatively small. Your reward potential, much bigger. I don't know if that's a golden rectangle, but that's what we want. We want our risk to be the smaller section. We want our reward to be the larger section. You want to risk, 38.2 to make 61.8 or better. Do Fibs work in all different time frames, and what time frames are you using? So I would say that they can kind of work in all time frames, but I pretty much operate on daily and hourly chart time frames. Daily and hourly charts on the FX side is really what I focus on. If I get into stocks and things like that, and even occasionally on the forex side, I'll use weekly charts. Now, I'm not going to pull these on 15 minutes would be decent. 5-minute time frames, 1-minute charts, no thank you. I'm not going to do any of that. And that becomes very, very random. So I really prefer for intraday trading the hourly chart. That's my bread and butter. That's where I tend to be. So yeah, you tend to get chopped up and spit out if you go to 1-minute, 5-minute charts. It's just very hard to really identify anything like that on a really, really short time period. Yeah, you can use those 1-minute charts, but when I say chew you up and spit you out, I think that's exactly what you'll end up finding. So let's look at these on an hourly chart time frame. This one just happens to be Kiwi US dollar, but here we have a move. So you'll find these. Now, we're not dragging the lines on any of these where we're not making new highs, but the Kiwi US dollar just made a new high. We actually have a Fibonacci we can draw. So I add the Fibonacci line. This one's bullish because we just went to new highs. I'm going to drag from peak down to trough. What does it tell me? Right now we're at 23.6. I'd really, because it's also the breakout zone, and this is to show you that this is exactly how I would trade. Meaning, I know where 38.2 is now. It's at 0.6340. I also know that there's some other things that are cool at that level. We had the prior resistance. This was the breakout zone and the gap up through there. So old resistance can act as new support, and it's right on top of that zone. In addition, I have a bullish crossover starting to happen in my short-term moving averages, the 20 period crossing above the 50, and as we go here, they're going to keep upward sloping and separating, which is a sign of bullish momentum. I have a range-bound base that we just broke out of. In other words, I'm combining factors. Am I getting excited about Kiwi US dollar pairs and a potential buy point just a little lower from here? You bet I am, because I have a multitude of things starting to line up that create a better probability of success. Again, we're measuring this recent move, what was made earlier today in that 6 or so hour period, and looking at the levels where we would buy in. And what does that currency pair tell you? Well, it tells you that if you buy this pair at 0.6340, it may pull back a little further, right? Now, you could decide to stop out before that number if that's too far away, or say I'll be fine with that. Put my stop down below that zone. But your upside target, best case scenario really, is a move all the way up here to 0.6416. The Fed meeting might be just what the doctor ordered to get it there this week, etc., etc. I think there's possibilities with that. So this is an hourly chart. I'm not just going to blindly go into a trade. I'm going to find factors like this. Whether you believe in Fibonacci's or not, I mean, Leonardo da Pisa might have been full of it. I don't know. But it at least helps you to manage your risk to reward, if nothing else. So the chart is how we can quantify where to take action, and it does a great job of just that. I hope you've enjoyed this today. If you have any additional questions or anything that we can ever do, don't hesitate to ask. We'll get these recordings cleaned up, and it'll be kind of in 3 sections. We've got Fibonacci history, Fibonacci's retracements, and then Fibonacci extensions. Hope you've enjoyed it. Thanks again, everyone. We'll see you next time. Goodbye.